Hi everyone, I'm here today to share some important updates about One Big Beautiful Bill, a topic that has been getting a lot of attention lately. In this session, we will go over the main changes in the new law, what is good, what you should watch out for, and how it could affect your taxes, retirement, and the long-term care planning. So now I will turn off my camera so it's easier for you to focus. Let's jump in. Before we begin, I would like to share a brief disclaimer. I am a licensed independent insurance agent. What I share today is for informational and reference purposes only, meant to offer additional perspectives on financial and insurance topics. If you have specific questions regarding taxes or legal matters, please consult a qualified professional, such as CPA, tax advisor, or attorney, to receive guidance tailored to your situation. Thank you, and now let's get started. What is the One Big Beautiful Bill, or call it short OBBB? It is a tax bill recently signed into law by President Trump on July 4, 2025. The bill significantly expands the Tax Cuts and Jobs Act of 2017, extending and broadening many of the tax benefits introduced under that law. OBBB includes approximately $4.5 trillion in tax cuts, with the primary goals of reducing taxes across the board by extending and enhancing the provisions from 2017 legislations. The bill is designed to benefit a wide range of groups, including low-income individuals, middle-class families, high earners, and small business owners. Almost every group stands to benefit in some ways from these tax reductions. A big question that needs to be answered is, where will the money come from to offset these massive tax cuts? With 4.5 trillion tax cuts, the government is giving up a significant amount of revenue. To offset that, they must take choices, either increase revenues elsewhere or cut spending. In this case, the bill places a strong focus on cutting government spending. So where are those cuts coming from? Primarily from major federal programs such as Medicaid, SNAP, also known as a food stamp program, student loans, Medicare, and among others. These are significant and broad reductions that impact a wide range of services. At the same time, the bill increases spending in other areas, particularly in defense and border security. Roughly $150 billion is allocated to defense and another $150 billion to immigration enforcement, including expanding efforts through agencies like ICE, mainly in response to issues surrounding illegal immigration. However, one of the most critical aspects of this bill is the increase in debt ceiling. At the time the bill was signed, our national debt stood at around $36.1 trillion. This legislation raises the debt ceiling by an additional $5 trillion, which means that by the end of President Trump's second term, if projection hold, our national debt could reach approximately $41.1 trillion. Now, let's take a look at 2025 federal income tax brackets. There are 7 tax brackets, just like in the past, including back in 2016, before the first Trump-Barrett tax cuts. However, the key difference is that almost all the brackets have been lowered, except the 10% and possibly the 24% bracket, which remain about the same. For example, the top bracket used to be 39.6%, but now is down to 37%. The 12% bracket used to be around 14%. The 22% bracket were previously closer to 23%. In addition to the lower rates, the income thresholds to each bracket have also been increased, especially for single filers, married couples filing jointly, and heads of household. That means you can earn more income before moving into higher tax bracket. So which tax bracket is the most strategic for maximizing Roth conversions? 24% bracket often offer better overall value, while the tax rate only increased 2% from 22% to 24%. The income limit nearly doubles from about $200,000 to almost $400,000 for Mary filing jointly. This range is one of the best windows to take advantage of current tax cuts. Let's take a look at how standard deductions compare between two different tax laws. Under the 2017 Tax Cuts and Jobs Act, the standard deduction was set at $15,000 for single filers, $22,500 for heads of household, and $30,000 for married couples filing jointly. Under One Big Beautiful Bill, beginning in 2025, the structure remaining essentially the same. The standard deductions could increase slightly to $17,750 for single filers, stay at $22,500 for head of household, and rise to $31,500 for married filings jointly. This adjustment is primarily tied to inflation indexing. Next, let's talk about the additional deductions for seniors under One Big Beautiful Bill. From 2025 to 2028, individuals aged 65 and older will receive an additional $6,000 added to their standard deduction. That means the married couple could get an extra $12,000 on top of their regular deduction. Previously, this additional amount was only $1,600 per person or $3,200 for married couples filing jointly or $2,000 if filing as single taxpayer. So this is a significant increase, and it could help many seniors in their 60s and early 70s avoid paying tax on their Social Security benefits or only pay tax on a small portion. One major change worth highlighting, especially for those living in the high tax states like California or New York, is adjustment to the SSA deduction, which stands for states and local tax. In the past, the SSA deductions just capped at $10,000. Under the new bill, the cap increases to $40,000. This allows taxpayers to deduct more if they are paying state income tax, property tax, or even sales tax, offering meaning relief in high tax areas. However, there are some eliminations. For income over $500,000, the deductions begin to phase out, and at least $600,000 or above, taxpayers can no longer claim the SSA deduction at all. For most Americans earning under $600,000, this represents a significant benefit that could reduce their federal tax bill. In the past, if you claimed the deduction, you could not deduct charitable deductions unless you filed using itemized deductions. For example, if you donated $1,000 to your church but did not itemize your deductions, you could not claim a tax benefit for that gift. Starting in 2026, the new law will allow a charitable deduction without itemizing, including $1,000 if filing as single taxpayer, $2,000 if filing jointly as a married couple. This is an additional deduction. It's adding on top of your standard deduction, not a replacement. Currently, automobile interest is not tax deductible. However, from 2025 to 2028, the new law will permit taxpayers to deduct up to $10,000 in interest paid on loans for vehicles assembled in United States. If you're planning to buy a car, this could be a valuable tax saving opportunity to consider. This is a significant change that will affect high-income earners, especially regarding total itemized deductions. Currently, there is no cap on how much benefit you can receive from itemized deductions. For example, if you in 37% tax bracket, your deductions reduce your taxable income at that full 37% rate. Under the new law, even if you are in 37% bracket, you only be able to deduct up to 35% of the value of your itemized deductions. In other words, you won't receive the full tax benefit from your deduction like you did before. Next, we will talk about personal exemption. Before 2018, each working individual could deduct around $4,050 for themselves, their spouse, or each independent. This helped reduce taxable income and lower their overall tax bill. From 2018 to 2025, under the 2017 tax law, the personal exemption was temporarily suspended. In exchange, the standard deduction was increased to offset the loss. Starting in 2026, under One Big Beautiful Bill, the personal exemption will be permanently eliminated. However, the enhanced standard deduction will be made permanent as well. As a result, most taxpayers will not see a loss compared to the previous system, and many may still come out ahead. From 2025 through 2028, if you earn income from tips or overtimes, you might be eligible to deduct a portion of that income from your federal taxable income. Here are the details. For tax income, you can deduct up to $25,000. For overtime income, if filing as single taxpayer, you can deduct up to $12,500. If filing jointly with spouse, the deduction increases to $25,000. However, this deduction begins to phase out once your adjusted gross income AGI exceeds $150,000 for single filers, $300,000 for married couples filing jointly. AGI refers to your total income after subtracting certain qualified deductions, such as contributions to retirement accounts, student loan interest, or eligible medical expenses. You can file your AGI on line 11 of IRS from 1040. However, it's important to note, while this deduction reduces their federal income tax, Social Security and Medicare taxes still applies as usual. Currently, you can qualify for tax credits when you purchase an electric vehicle, install solar panels, or upgrade your home with energy-sufficient improvements. However, under the new 2025 tax law, most of these clean energy tax credits are scheduled to expire in September of 2025. A key update in 2025 tax law is a temporary tax deduction for car loan interest. For 2025 to 2028, if you finance a vehicle that is assembled in the U.S., you might be eligible to deduct up to $10,000 in loan interest from your taxable income. Important note, the deduction applies only if you purchase the vehicle using a loan with interest, not cash. Let's discuss the child tax credit, a tax benefit for families with children. Under the current law, families can receive up to $2,000 per child under age 17, with $1,400 of that amount being refundable, meaning you can receive it even if you owe no federal income tax. For example, if you have one child and qualify for the child tax credit but don't owe any federal income tax that year, you still receive $1,400 refund from the government. Starting in 2025, under the new tax law, the child tax credit will increase to $2,200 per child. It will also be adjusted annually for inflation. The refundable portion remains at $1,400. However, the credit begins to phase out if your income exceeds $200,000 for single filers or $400,000 for married couples filing jointly. One of the most unique features of 2025 tax law of the creation of children's savings accounts, also known as Trump's Children's Savings Account. Under this new policy, the government will contribute $1,000 for each child born between 2025 and 2028 to open a savings account. Parents and employers can contribute up to $5,000 per year, and these contributions are tax-free. In addition, employers can contribute another $5,000 per year to their employees' child's account, also tax-exempt. This initiative aims to help families start saving early for their children's futures. It encourages businesses to support employees with young kids. One significant change in 2025 tax law is the introduction of remittance tax, a tax on money transfer abroad. Starting January 1st, 2026, if you transfer money overseas without going through a bank, for example, using services like Western Union, MoneyGram, or sending cash, you will be subject to 1% tax on total amount transferred. This policy does not distinguish by nationality, meaning it applies to both U.S. citizens and non-citizens. So if you frequently send money to relatives outside the U.S. using money transfer services, please be aware, this tax will take effect in 2026. Now let's turn to estate and gift taxes, an essential subject for families with large estates. In the Tax Cut and Jobs Act in 2017, each individual can transfer up to approximately $13 million to air tax-free. However, this elevated exemption is scheduled to expire at the end of 2025. Under the new One Big Beautiful Bill tax law, starting in 2026, the exemption will increase to $15 million per person, will be permanent, and will be adjusted annually for inflation. This is a positive change, especially for those planning to transfer wealth to future generations. Now let's talk about how the One Big Beautiful Bill can impact key social benefit programs. We will start with the premium tax credit. Currently, many low to middle income individuals receive help paying for health insurance through enhanced premium tax credits, a core part of the Affordable Care Act, also known as Obamacare. This tax credit helped reduce monthly premiums for those purchasing health plans through the health insurance market. In 2021, the credit was expanded under American Rescue Plan, making subsidies more generous and allow more people to qualify, including those earning above 400% of the federal poverty level who were previously ineligible. This expansion has allowed millions of Americans, especially early retirees, gig workers, and small business owners, to afford health coverage. However, under the One Big Beautiful Bill, this expanded version of the premium tax credit is set to expire after 2025. This means the program will reverse back to the original Obamacare rules, where fewer people qualify and the subsidies are smaller. By 2027, it is estimated that 3 to 4 million people no longer be able to afford health insurance, resulting in sharp increase in the uninsured rate. Next, let's talk about SNAP program, Supplemental Nutrition Assistance Program, which help millions of Americans can buy food. Under One Big Beautiful Bill, The government plans to cut between 186 billion to nearly 300 billion from SNAP over 10 years period from 2025 to 2034. That is a huge reduction, and it means fewer benefits or tighter eligibility rules for many families. And most significantly, Medicaid, the primary health insurance program for low-income individuals and families, could see a drastic 1 trillion cut between 2025 and 2034. These changes could seriously affect the most vulnerable population, including seniors, disabled individuals, and families who depend on government support for basic health care and food security. On this slide, you can see the concerning impact that the one big beautiful bill may have on two of the most important social safety net programs in the U.S., Social Security and Medicare. On the left, you will see a chart published by the Committee for a Responsible Federal Budget, CRFB.gov. This nonpartisan nonprofit tracks federal fiscal policy. According to their analysis, if one big beautiful bill is enacted, the Social Security Retirement Trust Fund could be depleted 1 year earlier than expected by mid-2032 rather than 2033. This could trigger an automatic cut of up to 24% in monthly retirement benefits of millions of Americans. But that's not all. The Medicare Hospital Insurance Trust Fund is also projected to run out around the same time, which could result in an 11% reduction in reimbursement for medical services, directly impacting both the access and quality of care people receive. It's important to understand Medicare does not just serve seniors. It also provides critical health coverage for millions of people with disabilities, those with chronic illness, and it plays a vital role in keeping the entire hospital system operating. This means even working-age adults could be affected. If Medicare funding is cut, healthcare costs may rise. Some doctors may reduce their patient intakes, and hospitals could face even more strain. On the right side of the slide, we've included a screenshot from an official publication by Social Security Administration titled Social Security Retirement Benefits and Private Annuities, a comparative analysis. This document compares income from Social Security with that from private annuities. The report emphasizes that as public retirement programs become increasingly strained, Americans should consider alternative income sources to protect their financial security in retirement. One highly regarded solution is the use of annuities, which, like Social Security, can offer guaranteed lifetime income, but without depending on government funding. Annuities are privately owned, personally funded, and under your control, giving individuals more flexibilities and security in their financial planning. While the report does not implicitly say don't rely on the government, the message is clear. Americans should not depend solely on public programs. Instead, they must take responsibility for their retirement by creating a supplemental plan to safeguard our income and lifestyle. Together, these two visuals send a powerful message. We cannot solely rely on government safety net, especially in an era of tightening budgets and rapidly aging population. Being proactive with financial planning and exploring private solutions such as annuity is essential to protecting ourselves and our families from financial risk that lies ahead. Thank you so much for taking the time to join me today. As you've seen, Social Security, Medicare, and Medicaid are under severe financial pressure and may not to fully support retirement or cover long-term care costs in the future. That is why it's crucial to begin planning early. With a clear plan in place, we can avoid being caught off guard by changing in government policy or market conditions. I am here to support you, to help you analyze your needs, explore your options, and build a plan that aligns with your financial situation and personal goals. If you have any questions or would like to talk on one-on-one, feel free to leave a comment below or contact me directly. I always take the time to read and respond carefully to each message, providing the best support possible. And if you found this content helpful, don't forget to subscribe to the channel so that you can continue receiving valuable insights on finance and insurance in the future video. Once again, thank you so much, and I wish you a good health, financial peace of mind, and long-term security.